Okay, good morning, everybody. After all those speeches and all the data points that we got from the speakers in the first session, from Ashok and including the minister, I was already a confused human being as far as markets go. I'm a little more confused now. Where are we heading? It actually sitting there, it reminded me of that somebody was teaching me to learn this dance called tango. 2 steps forward, 1 step backward, 3 steps to the side. And that's the situation that we see when we come to the markets of India. So today we have Badri Nimas, the Managing Director, Country Treasurer and Head Markets and Security Services of South Asia at Citibank. He has been recently announced as the Markets and Treasury Regional Head for Asia Pacific. And he's responsible for overseeing the management of markets treasury activity across APAC. Prior to this role, Badri was the head of markets for Citi South Asia and country treasurer Citi India. He was responsible for delivering on strategic initiatives and business plans for Citi's clients across the markets, both products and services. Besides being responsible for actively managing the balance sheet and investment portfolio of Citibank NA, including its key affiliates, he ran the trading business for Citibank across rates, foreign exchange, and derivatives products, including market making, pricing for flows, solutions, etc. What better guy to have today than to speak about all this? And I do hope you don't make us even more confused about all the situation that there is, especially for a non-finance guy like me. I presume some of you will understand this more. Badri is a specialist in treasury and asset liability management, with over a decade experience in Indian fixed income, money markets, and foreign exchange markets, and is fully conversant with the present and the evolving local and global regulatory framework related to balance sheet management. His overall banking experience is over 23 years. He has been a member of the RBI Committee on Pricing of Credit and has been part of various industry bodies. He also regularly appears in the media. Now, let me pick a word from the minister: unprecedented economic situation. That's what he spoke about. An unprecedented market situation. Somebody says some segments are going down, somebody says some countries are going down, others say they're doing very, very well. And then the logic of stock markets and foreign exchange, which should be following how the countries are doing, seems to be doing the opposite, at least to me. We have US, one of the highly, what you call, leveraged countries. I was in the US a couple of months ago, and I found that some parts of US is worse than third world countries compared to what we are doing, and yet we have the US dollar going up there and the Indian rupee going down. For what reason? We'd probably like to know. So this is the kind of situation we are facing today. It's a volatile market. Somebody coined this word VUCA a few years ago. Today is really the VUCA world. And today, let's not limit ourselves to, when we mean markets, we normally talk of stock market or the foreign exchange market. But all these are impacted by also the other economic indicators that one sees. So let's sort of look at not just the stock market and the currency market and the share market, etc., and let's look at it in the broader sense as to what are the markets for goods and services today, and perhaps the job market too, because ultimately all these are connected in one way or the other and will impact each other, though they may not have a direct relationship. The current period is unbelievably volatile. Look at this morning's news. First page, World Bank or whatever says India's GDP will go up from 6.5 to 6.9. 14th page, Fitch says India's GDP will go from 6.5 to 6.2. Now, whom do I believe? Is GDP really relevant? The minister spoke about per capita GSDP or GDP. What is the use of this if all this wealth is sitting at the top level and we're just dividing by a denominator with all the people? Is the money reaching the people where it really has to reach? That's another issue that we have to look at. And the minister also alluded to that. The more the distance in terms of economic disparity, the more trouble we will have in future. Many years ago, I remember talking to a group, almost 20 years ago. If I said, if you don't have this disparity come down, this power distance or the economic distance come down, the red flags will not fly from Kathmandu to Khammam, but will fly from Kanyakumari to Kashmir. Because man lives on hope. You remove hope from them and their back is against a wall, they'll have problems. So it's a good point that we should discuss, see how we can broad base this economic upsurge that this country seems to be having over the last few years. There are ups and downs, but I think that momentarily the long-term story should be good. But what I still can't understand when it comes to stocks is why are these stocks doing so well? And what is the sentiment behind? Every time I ask a stock market guy, he says, oh, no, numbers are not the issue, it's a sentiment. I mean, what do you mean? How do you run things with sentiments? If Gopal or Ravi or Ashok run their businesses on sentiment, we'll be in a terrible situation, basically. We need those stats, we need those numbers. So that's the kind of situation we're talking of. And who spoke about, I think, I don't know if it's Ashok or yeah, you spoke about deglobalization, or I think Gopal spoke about deglobalization. Look at the situation we're in today. At one point of time, everybody spoke about globalization. Today, we are building fences, economic fences all over the place. We're getting very nationalistic in our view. In fact, the Americans were the only ones who said, America's interests come first. Now, India say India's interests come first. Everybody's interests come first. So what's the situation going to be? And look at the political kind of scenario that we have. Wars that we don't want, that have been created. People who are sort of belligerent on the borders. And that has impacted business in many, many ways. First of all, starting with supply chain that Ashok spoke about. We have an issue today, and the Chinese are going in a strange fashion. So ultimately, I think when you look at India and many other countries, we'll have to look after ourselves. Fortunately, we have a very large market. Fortunately, as well as unfortunately, we have still about 50% of the people who are really aspiring to come out of the poverty that they are in, which means we're going to create markets if we get the act right. And hopefully, the sentiment that is today against China, they called it China +1. I don't know if we are +1, if Vietnam is +1, but I'll say that the sentiment that is against China are moving some people towards India. Very strangely, I got a call from a Chinese guy in China about 3 months ago through a contact of mine saying that I want to move my factory from China to India. I said, why do you want to do that? He says, my customers are not buying things from China. I would like my factory to move to India because they're more available. That's the situation. Are we able to take advantage of this kind of a situation? So where does India stand in terms of all this? So these are the questions that Badri is going to make a presentation. And perhaps we'll ask a few questions. We cannot have all the answers today, but perhaps you will go home with a little more confusion with a few more questions. And you will think about coming back with the answers. So, and if you see the growth, like just now when Ashok spoke, he said the middle income is getting squeezed because of the markets are going, and the luxury goods are flying. This is exactly what we have seen. You ask all the high-end goods, whether it's cars or anything that they are growing, and they're growing. I come from the pump industry. I've been talking to a lot of them. The middle kind of market has shrunk by 20%, and the top-end market has grown by 30%. It's an amazing kind of situation, and that leads to even more difficulty. So we need to really look at it very granularly and see which segment that we are in and how we're going to sort of survive that. So if we have to take advantage of all this, we have to listen to the various people who are good at envisaging what would happen. And last but not least, I like what I was wanting to ask the minister, how did you become a politician? Because he spoke about execution. We Indians are great at planning, phenomenal plans. The moment we start executing, everything goes for 6. So execution is very, very vital, and let's see what we can do. So the pace of reforms that we have today, is it good enough? Are we going to execute it well? And are we although we are professing, even at the central level as well as the state levels, that we would like to welcome investments, even if it is foreign direct investment, or even perhaps more foreign direct investment to improve our infrastructure, do we have the ecosystem to actually attract these people in terms of ease of doing business and reduction in the complexity of our bureaucratic procedures, whether it's from the government, public sector, or private sector? So now I'll hand it over to Badri. It's all yours, Badri.
Yeah. Thank you, Mr. Ranganath, and firstly, thanks to Mr. Gopal and the CII team for having me here. I think it was a great speech, Mr. Ashok, to hear you. You set the context, you spoke a lot about some of the things I wanted to cover, and also very impressed with the speech of the minister. I think he's obviously an investment banker, once an investment banker, always an investment banker. So when somebody talks about the inversion of the yield curve between 2s and 10s, you know that he's a global banker, right? So, but a great speech, a lot of content in that, a lot of takeaways, even from someone like me, who's not from right now in the state. But let me just set a few responses to some of the points you mentioned, Mr. Ranganath, first, before I get into my presentation. You said we'll hopefully have the demystification of the markets. Markets are very volatile and all. Let me start on a lighter note by saying that people who think that markets will become easy and predictable. We're in Tamil Nadu. I'm from Chennai. Let me say this. There's an old Tamil song which says, in different context, but it's super applicable for markets, which says, Nilai maarum ulagil, nilaikum endra kanavil vaazhum manija dadi. I don't know if it's from a movie, Umai Virigal, some 30, 40 years back, I think. It's about life, but markets, it's applicable to markets. So for all of us who think that markets will be calm and not changing, that's like a utopia and dream which we'll never realize. So it is going to be obviously a very interesting time. I think what is really different this time is, again, I'm going to draw on a film reference. The opening sequence of Ponniyin Selvan starts with this whole commentary from Kamal Hassan's voice, which is saying that the dark clouds of stormy clouds are gathering around the entire Chola Empire. Frankly, if you look at the world stage, it's pretty much that. Every pocket, every part of the world, there is a distinct, stormy, gloomy clouds. And that's what I think, makes this a very, very challenging global environment. And the good thing is, from an India point of view, I think if we were to use the word, it's an oasis of tranquility. We have, and we have been having a lot of visitors to India, both from investors and our own global offices. And people can't just but notice the distinct, difference. People, especially coming from the Western world, are coming from a place where there's completely dark clouds overhang and on the horizon. But when you come to India and you see the kind of optimism, the growth, the kind of, happening here, people just love it, right? And people can see the energy and stuff. So, except when it comes to stock market, I'm an optimist. So I would say that, it's a question of how you want to see. But I think there is a lot of tailwinds for India, and we'll talk about that. The minister talked about that as well. The question is, how do we make use of it? A couple of other things you mentioned about the equity valuations and stuff. The one thing I would say is that more than the GDP growth, I think the EPS growth is important. And one of the reasons why Indian stock markets have done well is, I think India has a good track record, and you corporates have a good track record of translating GDP growth into EPS growth. And when it comes to many other countries, China, for example, have had such very bad history of Chinese corporates translating GDP growth into EPS growth. And one of the reasons why India is currently doing better is the last 3 years, I think we've had very strong EPS growth of companies. The question is, will it sustain? But at least that partly explains why India has done better. You talked about the difference in demand for various types of goods. Again, the way we characterize it from an economy point of view is more a K-shaped recovery. What we think is happening in India is that there is a certain population which is coming out of the COVID and the pandemic in much, much economic and financial health. And that part of the population, which is probably the hyper end and so on, is obviously spending well, is doing a lot more travel and so on, and you're seeing that in demand for some of those high-end goods. Whereas there's another part of the population which, while economic growth is bouncing back, the COVID impact to that segment, the lower SME segments, and then the self-employed segment, and those people who are into contact services, etc. While they're coming out of the pandemic well, but their ability to spend that savings is not there because they probably are more indebted, more leveraged, they need to pay back, and obviously people worry about new viruses and stuff. So the confidence in that segment is bad, and that's where we're seeing it a bit K-shaped. We are also seeing a bit of a rural-urban divide in terms of economic growth. We think the urban growth is much, much stronger than the rural growth. Because of the inflation situation, the terms of trade of the farmer and the agriculture have not necessarily got better. Input costs have become much higher, MSP prices haven't gone up. So, and then there's been a big shift in labor also from urban to rural. Not entire reverse migration has happened back. And therefore, we believe that economically, the rural economy is not in that great a health compared to the urban economy. Whether this could become an issue for 2024 is to be seen, but there is that difference, which also explains some of the gaps in the way we're seeing. Let me get into the presentation, and I'll talk a little bit about, and if it's okay, I'll probably stand and use the highlight. Yeah, I have a pointer and the mic, so hopefully it is. So what I'm trying to do is, set the stage a little bit about trying to explain. There's so much things going on, right? There's the war, there's the US, and so on, and just try and put a bit of a theme and a context to it so that we can all go away saying, what are the things that we need to track, right? And if we just move on quickly, right? The global themes, what are the key themes, right? I think this is the biggest one from an India point, but from a global point, which is a big theme outlay. And again, Mr. Finance Minister actually laid the context and talked about some of this. And two things that he talked about, which is there here right up front, right? Actually, let me first look at this chart, the balance sheet expansion. This plots the percentage of GDP, but you could express it in absolute dollars as well. The balance sheet of the G4 central banks. And if you look at it, they were around the G4 aggregate was around the 35% of GDP. If you look at the US Fed itself was around 20% of the GDP as of end December 2019, just before pandemic. And if you look at the scale of fiscal expansion, within 4 months, they moved from a 20% in the US to almost 35%. That's like, almost doubling, the amount of monetary expansion that the US did. And similarly across, if you look at the G4 economies, you're talking about a 35% going up to 55%. To put it in numbers, Fed balance sheet expanded from $4 trillion to about $8.5 trillion in 2 years. And for an economy which didn't even shut down fully, right? Unlike India, which was on a big lockdown, the US didn't really have that kind of a massive lockdown. It's too much fiscal expansion. And coming in the wake of obviously the supply chain, issues and so on, what you have is a huge spike in inflation in the US. So if you look at it, from inflation being around the core goods around probably 0 to 2%, and the overall services inflation around 2%, it has gone up to about 7% and settling, currently it's around 6%. Now for an economy which is very aging economy, where more people are living out of savings and pensions compared to, in the rest of the population, high inflation simply means loss in standard of living, right? And that is a big problem. The Fed's mandate is 2%, the inflation is running at 7%. And obviously, therefore, the reason the Fed is going so aggressive right now is because they were actually wrong about their assessment of inflation last year. We are in December? I think about 15 months back, even last September, August, the US Fed Chairman Powell was actually telling the world that this inflation is transient. It is just because of some of the supply side issues around COVID. As the economy normalizes, the pandemic recedes, the inflation will come down. They didn't actually believe that this is an inflation for them to really go after. It was only when they saw how persistent it was that they started going. And given they were wrong last year, now they really want to get ahead of the curve, and therefore they're going super hawkish. And what have they done is increasing rates. So from pretty much 0% rates, they've taken up rates to about 4%. And the expectation is that the Fed will hike another 100 to 125 basis points at a minimum in the next 3 months. So there is a policy or FOMC meeting in December. The expectation is another 50 bips, and then another 50 bips in Feb first week policy, and then in March. So it's probably by March is when we're expecting the Fed to come to a neutral, and probably talk about pivot. You'll hear the term pivot, which is to say, oh, Fed is going to stop. At this point in time, if you look at it, the Fed is looking at basically 2 data points to decide whether they're done, right? One is how the labor market is, and the labor market in US is extremely strong, and therefore, the Fed is nowhere at the end at this point in time. And then there's this is the payroll growth, right? The growth in the US job market, it's quite strong, and therefore, till the Fed sees that stopping, they're going to, continue to hike. The second thing is also they're looking at wage growth. The wage growth in the US is quite high. Until they see labor market in terms of hirings reduce, until they see wage growth recede, they're not going to get the comfort that inflation is going to come under control. Remember, their mandate is 2%. So while there'll be a base effect which will pull it down next year, but there's still not enough visibility to say it'll come to 2. People can say it'll come to 4, 5, maybe 3, but to get to 2, they probably need to do a lot more. And that's what they have done in the last few months. So they've increased the interest rate substantially. Now, what does it mean also from a growth point of view? There's going to be consequence for this. So if you look at it, this is the whole doom and gloom, because people are thinking that economies are either already in recession, which is really the Eurozone, right? They're already technically in recession and growth is obviously slow, and that's impact because of the war and impact because of high energy prices, and they're also hiking rates. But the US, which is really growing well, the expectation is by second half next year, they'll also go into recession. In a sense, it's an engineered recession, because the Fed is basically saying, I want the economy to slow down, I want job losses to happen, only then we can be sure that inflation is going to fall. So they're saying they're going to keep hiking till they engineer landing. The debate is whether you can get a soft landing or a hard landing. A lot of people believe that the window for soft landing is closed, and therefore, you have no option but to have a more, stronger recession in the US. But the expectation is for recession there. UK is it's a basket case. It would be it's worse than an EM right now in terms of the challenges they have. And then even some of the emerging markets like Brazil, Mexico is expected to go into a recession next year. So there is a lot of expectation of, except China, right? Because China is, and I'll talk about China in a bit, but the whole thing is that there is going to be substantial slowdown globally next year as a consequence of all of this rate hikes, and to bring inflation under control. What is the other impact of the US central bank rate hikes is really on the dollar. Dollar is still the primary currency in the world, and therefore, as the US keeps hiking rates, there's been a substantial strength in the dollar index. So if you look at the dollar, it's strengthened substantially in the last few months, right? And we saw the rupee also depreciate along with it. In fact, rupee has done relatively better, but against euro, against pound, against yen, dollar is substantially weakened. What is our outlook on dollar? We think that the next year, first half, because the Fed is going to continue to hike, and if you look at this particular growth chart, the US is the US is still doing well, right? So at this point in time, and we are now here, even the next 2 quarters, we are not predicting a recession in the US. So US is doing economically much better. And if you have the central bank hiking rates and the economy doing better, obviously the currency has to strengthen, which is why you're seeing a persistent dollar strength compared to some of the EM countries. So we think that the dollar will continue to strengthen for some more time, maybe another quarter to 2 quarters. But second half of next year, what is likely to happen, all the impact of this rate hikes in the US will bring down their growth, and Fed will also be on a pause. Whether they're going to cut is too early to say, but then that's when you're going to see peak dollar, and then the other currencies starting to move up. The other big story which is happening in the world, which has an impact on India, is on the commodities, right? Now, oil is the biggest rig market in the world, so it's very difficult to predict the price of oil with any certain conviction. Citi forecast through the time oil went to 120, our global commodity expert always said oil will come off, and we used to like saying, oh, it's very embarrassing to keep putting this forecast to clients, because oil is only going up and we keep having this whole thing, and then eventually oil comes off. But again, they talk about the broken clock, right? You're always 2 times correct. So, a forecast which works only in the long term is of no use. But overall, I think, the broad view from our point is that if you look at the demand supply from a global point of view on crude, it's not that bad. And therefore, there is scope for oil to come off. The only reason why oil was so high for most of this year was related to various kinds of supply shocks and so on. And as some of those get addressed, the expectation is that oil will moderate. Also, with the kind of outlook on the world economy that I showed to you in the chart previous, if most of the world large economies are going to go into recession, there's no reason for having a very bullish outlook on oil. So the conventional wisdom from a demand supply is for oil to fall. If you look at this part, we think that oil will be around 88 and 75 and so on. So this is our expectation. There's a lot of questions, and I'll probably around Russia oil and so on. What I would say is that India has done a good job as things stand of trying to hold our own in terms of how we negotiate. So our Russia oil imports have gone up from less than 1% of oil to about 20%. And even though there's been a latest news of price caps and so on, I think India believes that we should be able to navigate this. The price cap is a very complicated stuff, but for those of you who are interested, I'll just tell you this much. I think the intent of the price caps by the US themselves is to make it in a manner that it comes into play, it gets accepted without really screwing the supply in such a way that oil actually spikes. It's not in US interest, it's in nobody's interest for oil to go up, back, and so on. So the price cap that they put at $60 is in a way a soft landing of this particular thing. You could look at it to say that, look, this is just a posturing, and therefore, there's no major practical impact on the price cap. The other way to look at it is they want to get it accepted with a very little impact, but then down the line in 2 months, they could just reduce that price cap from 60 to 50 and 40 and squeeze Russia. We'll see how that goes, but at this point, the broad sense is the price caps are well advertised, come in so, in a manner which is known to everybody, that it's not having any immediate impact on oil prices, which is why you're not seeing Brent actually go up, but more reacting to the recession expectations. Okay, let me come to India. And again, this morning we had the RBI hike rates by another 35 basis points. I think I was just tracking the governor's speech a little bit along, and I think he's talking about inflation risk continuing to be, there. Core inflation is entrenched. You could take away a little bit. I mean, my sense was from reading some of the headlines, I didn't hear them, of course, is that it's a little bit tilted on the hawkish side, which is not necessarily bad. Of course, I understand that I'm in the midst of industry, people, so I'll be careful. But I think in general, from a macro stability point of view, I think, for us, if you ask me, it's better to be a little bit in this kind of world on the hawkish side rather than on the dovish side. And I'll explain that. But he's talked about core inflation being sticky. The one word I caught was, he says the MPC in general feels that more calibrated action is needed. I don't know if in the press conference he'll explain how much, but today the repo rate has gone up from 4% in April or May when he hiked midterm to 6.25 today. So that's a massive 225 basis points increase. And obviously, a lot of individuals and corporates who have got loans linked to floating rate benchmarks are going to see the transmission. But I would say from an India point of view, the current rates are more like mean reversion. I don't think we've tightened if you look at it from a historical last 20 years or 2 decades point of view. 4% was an aberration. For an economy which is growing at 6-7% with an inflation at 5 to 7%, 4% interest rates are simply unsustainable. And to that extent, I would think it's been a mean reversion by RBI. Question really is, do we need to go much higher? That's something we'll talk a little bit about. But he did reduce the growth forecast from 7 to 6.7%, and inflation, they've largely left it at the same level. So it tells you where their bias is in terms of how they see the growth inflation. Where are we on the thing? First, let me talk about the drivers, right? And I'll come to growth. I think the big thing that India did well was manage the COVID without too much of the fiscal expansion the way we saw in some of the other countries. And that's probably the good thing. So if you look at the fiscal deficit, we moved from about 3.5% to about 6.5%, which is not that large when you look at it in historical context. But the problem is that, as COVID is gone and we're back to normal GDP, we're struggling to bring that 6.5 back to 3.5%. And that is a problem because I think, we are having a very high fiscal deficit, which is not sustainable. People ask me, are you worried about growth? When you have a center fiscal deficit of 6.5% and a state fiscal of about 3 to 3.5%, you're talking about a 9.5%, 10% fiscal situation. That's a massive fiscal impulse, right? If you have that kind of impulse of fiscal support to the economy and you still can't grow 6%, right, then God help us. So I don't think, you're in a situation where you need to be worried about, whether we're getting enough support from a growth point, at least from a fiscal point. It's massive support. Just to tell you, pre-COVID, the central fiscal deficit was 3.5%, 3.4% to be precise. To move from 3.4 to 6.5 is massive. And similarly, while states were around 2.5% at that time, they've gone up to 3.3. State fiscal has actually not that, gone up that substantially. But that's also because with GST coming in, there are less levers for the state. But overall, I think we are in good shape on the fiscal. I mean, we have a large fiscal deficit. And I think the government has to find ways to reduce this from a macro stability point of view. And one other thing which is there, I don't know if it's there in the next slide somewhere, but I mean, you'll all be aware about the GST collections, right? If you look at it, there is a massive formalization of the economy which has happened pre-COVID, which has accelerated post-COVID, and that has led to, at the same GDP level, the GST collections substantially going up, almost 30–40%. And that's a lot of revenues for the government. So when we are talking about, a fiscal deficit as a percentage of GDP, you also have to remember that there's been revenue buoyancy despite COVID, right? GDP is flat, but GST collections from 1 lakh crores have moved to 1 lakh, 1 lakh 5,000 have moved to 1 lakh 35,000, 1 lakh 40. And that is, the government is spending that money. The good thing is there's a lot of capex spending. So if you look at FY22, there is, the center and state are doing a lot of capex. In fact, the finance minister today talked about the capex and how the capex is going to grow for Tamil Nadu. And he talked about the execution risks, right? Whether we'll have the ability to deliver that kind of capex. But today, I think there's been a lot of capex, at least from a central point of view, which is there. So the fiscal impact is high. What we think the next year budget will focus on is continue to focus on capex, and then getting into 23 and 24, I think there'll be a lot of focus on rural schemes as well. Monetary policy, right? So like I was saying, we've come from a 4% to, with today's hike at about 6.25. We obviously predicted this hike. We think that 6.25, our economists view that we'll probably stay at this level. We are close to the neutral level. The hike increases from here on should be maybe one more 25 you'll get. 6.5 is probably neutral. And there is a possibility that there could be another cut in the later part of next year. Again, this is our economist view. Do I subscribe to it? Personally speaking, I don't think so, because I think it's too early to say. I don't know, but I think it's too early to say that there'll be a rate cut later part. And we'll talk a little bit about what will drive that, right? And that comes to inflation in India. So if you look at inflation in India, right, there was a spike in FY23 that was largely driven by food. Our own expectation is that the inflation at 7% has peaked. And from here on, we will go towards the 6% and probably decline towards the 5%. So for next year, if you look at our own inflation, we think that Q4, which is the next quarter, will be at 5.9, and then we'll go down to 4.8, and then stabilize around the 5% level. So this is our forecast, which is a reasonably good space. The RBI's central target is 4%, but will they necessarily hike to say that we need to push inflation to 4? We don't think that this RBI governor or the MPC, unlike the previous persons, are so focused on a one number inflation. I think they're looking more at the momentum. And if they believe that growth is going to moderate and inflation is around this, we don't think they'll necessarily try to hike enough to push inflation to 4%. So 5% is something we can live with. The risk is that these are all forecast. If you get any external shocks, or you get another, because the growth is, let's say, continues to be strong, you get another, or a food price driven inflation, commodity driven, then RBI has to do a lot more. But right now, we think we're closer to the neutral rate. And inflation is likely to come down next year. The governors talked about core inflation, which is the point I've made here as well. The core inflation continues to be, we track something called the trim mean, which is like you take 20% off and then look at the core, absolute core. And core is without food, without fuel. So that it's really the underlying goods and services. That has been around 6%, 6.5%, quite sticky. I think the RBI will want this to come lower. And again, you all can be a good barometer of yourself, knowing how this is likely to pan out on wage growth. I think the last 2 years we've had reasonable wage growth in corporate India. Again, you'll have to basically, if you think that your own wage bills are continuing to grow at, let's say, double digits or whatever, I mean, forget the hiring, I'm just talking about the wage growth on the back of annual increases, then, some of this inflation could be a little bit more sticky. And that's something to watch out for. External sector, I think this is one thing which we need to be cautious about. If you ask me what is a big risk for India, it's not so much growth, it's not so much inflation, but it's the external sector. And if you, okay, just to put some numbers, right? We've seen the current account deficit at about 3% plus of GDP in this fiscal, right? And that is a problem for us because we can finance a current account deficit of about 2.5 to 2.7%. If current account deficit goes above 3%, then it becomes a big challenge for us to finance because we are dependent then on capital flows. If you look at the capital flows, they were very positive in the last 3 years. We had huge, our current account went down, but we had like 40-50 billion of FDI flows, and we had about 30-40 billion of portfolio flows. And that led to a large BOP surplus. This year, if you look at our BOP surplus, it's fallen to about a negative. We have 35 billion of negative outflows. So one of the reasons you're seeing the exchange reserves of the RBI fall is because we've had an outflow of about 30 billion overall. Now, if our CAD is 3% plus, then it's going to be a challenge because it's going to be a little bit self-fulfilling, right? If people think that you have a high financing requirement, then people are going to actually pull away because people are going to have a less constructive view on the currency, and therefore portfolio flows may not happen. And that could actually be self-fulfilling, and therefore we need to be careful. Now, again, one variable that we tracked even pre-COVID was whenever our economy grew by more than 6%, 6.5%, we found that India's imports, especially from China, went up substantially, and our current account went up. So there are two reasons for CAD to go up. One is, of course, the oil prices, and the fact that oil has come off from 100 plus to about 80 today is good news. And if oil remains moderate at around 75, 80, I think that's good for us. But the other thing is the whole, we are a demand importing, economy. We don't manufacture enough, right? So our imports from China, and we don't import fuel or gold from China or defense, right? So our imports from China in the last 12 months have gone up, now has gone to about $75 billion. So that's a massive amount, right, of imports. And that's really, everything in this room and everything around when you consume and so on. So the challenge for India in the last 4-5 years has been that if you have high growth, then our CAD has started shooting up. And the moment CAD starts shooting up, then it puts pressure on the currency. And which is why I think that this is something in a world where commodity price outlook, especially oil, is still very iffy. I think we need to be very careful to keep CAD under 2.5 to 2.7%. Even this morning, the governor's RBI speech, MPC's this thing, they're saying that CAD, they believe, is under control. But we'll have to just be watching out for this. And this is why, if you ask me from a monetary policy, if US is going to be at 5%, if India stops at 6%, you're going to have a lot of problems from a currency point of view. So, and this is a big challenge for all emerging market central bankers. If US is at 5%, then what kind of buffer you need from an interest rate point of view to defend your currency? And that's where I think even the RBI is very mindful of the fact that you can't suddenly stop and stay already. Before you know whether the Fed is stopping, it's very early for you to say, I'm going to stop, because then you'll have a run on your currency in a big way. And this is something we need to watch out for. Our own forecast for rupee is a bit of, we think that broad US strength is likely to, be there for some more months, like I said, and therefore we have a slight dovish or a depreciating bias for the rupee, at least for the next few months. On the rates, like I said, we expect, a gradual shift in bond yields to 760 on the 10-year, which is around 730, but we think the RBI is probably closer to the terminal rate in this cycle for now. But one thing I want to talk about on liquidity and interest rates, I think as corporates, what you need to be mindful of is that the liquidity in the banking system is tightening substantially. In the beginning of the year, we had 12 lakh crores of surplus in the banking system. The RBI has tightened that to about 2.5 lakh crores today. That's a substantial reduction. And if you look at the banking system credit growth, they're running at about 15 to 17%. Deposit growth is running at 9%. And if you look at the listed banks LCR, right? LCR is the Basel Liquidity Coverage Ratio, which tells you how much liquidity buffer banks have. All the banks are now back to the pre-COVID levels, because during COVID, they all built substantial buffers. And my own sense is that this credit deposit growth ratio is not sustainable. And therefore, either of two things will happen. One is credit will become very expensive because they'll have to ration credit, to between borrowers, or they'll have to increase their deposit rate substantially, right? And you're already seeing that many banks have already started. I mean, 1 year CD was almost close to 8% last month. Some of the banks are raising CDs at 8%, 7.6, and so on. And I think retail deposit rates have started going up. And you will see, getting into Q1 next year, you will see, deposit rates and credit pricing go up very sharply. I think we are in for a very tight liquidity condition, so be wary of that as a corporate. On equities, I think what we broadly, again, I don't want to get into more, on the equities. What we think is that India has done well for some good reasons. What is the prognosis from here on? Valuations are rich. So you'll have to track, for the first time in 3 years, we are starting to see companies actually reduce their EPS growth forecast. We didn't see that in the last 2 years. So as that happens, then I think sector-wise, you'll have to see whether there'll be moderation on valuations. So we don't see much upside on equities from here on at a headline level, though India continues to attract flows. Lastly, I just want to stop with a couple of slides around the big picture, right? Because, again, coming from a global bank, and again, we're getting a lot of people who come into India, both as investors, corporates, and so on. What we see is that India is definitely in the midst of a transformation. Maybe a lot of us don't realize it when you're sitting in the middle of it, but I think it's important to keep that perspective. There's something happening here in terms of the way our economy is getting formalized, the way our economy is getting financialized, and some of these are trends which are really remarkable when you look at the size and flow of monies going into financial sectors, right? The number of AIFs coming and setting up, the way capital is being moved around, in India. Right? And AIFs are going to move a lot of capital beyond banks. Banks could get disintermediated because there's a lot of AIFs coming and setting up. And they're all looking at private investment opportunities and so on. So there is, and then when we talk to FPIs, we met GIC in the last 1 month. We met RDR, again, sovereign wealth funds. The amount of investments they're doing in India, and there's a lot of conversations at a government to government level are happening. So it's not just that, they're looking at this just as a opportunity from an investment in the near term, but the amount of pods they're setting up. So it's not just about saying I'll buy Indian equities. It's about saying that, I want to buy India infrastructure. I want to invest in India's renewables. I want to invest in, some of the, startups in India on the fintech space. So they're setting up specialized, pods, which are where there's not a dearth of talent of Indians out there in the world. So the people who are coming and looking at it, and they know a lot more about ground level than some of us bankers in terms of, what's happening. So there's a lot of attention from people. The other thing which is happening is also the formalization, right? The GST collections I talked about, and also the digitization. Again, this is not to be discounted. I think between the payment infrastructure ecosystem in India, which RBI is created, and the digital infrastructure and because of the whole 4G, 5Gs and adoption of that by the large population, there's a whole host of monies coming in, capital coming into the country, which is looking at these. And again, if we want to grow, and we talked about Tamil Nadu 1 trillion, India the 5 trillion story, we need capital. We can't fund it from domestic, but there's a lot of capital out there coming in. Lastly, I would also say the whole China +1 and what's happening. I think there are two things, right? One is the whole supply chain alternates, right? And I think Mr. Ranganath talked about, are we the +1, and there is competition, so we need to get our act right. But importantly, also there's this whole US sanctions sword hanging over from a political point of view. So one of the biggest fears after Russia invaded Ukraine on a Thursday morning, if I'm not mistaken, and then the sanctions which came in, the playbook for every global investment or a bank is today to say that what if China lands a plane in Taiwan on a Monday morning? Now what happens is you'll get sanctions from US, not just Taiwan, right? It's about China, it's about Hong Kong, and therefore the kind of implications are huge. So what happens for investment money managers is that if you are got a huge portfolio today allocated to North Asia, especially China, Hong Kong, Taiwan, you're trying to say, you want panic and sell, but you're not going to increase that investment. So you're looking at where can I, shift the balance? How do I, create more, less stress for me? And in that sense, I mean, I think you mentioned about a Chinese corporate calling you. I can tell you, I mean, Tamil Nadu has attracted a lot of, companies from Taiwan and so on the PLI schemes and others. But again, there's a Taiwan company who says that they're going to, in the next 3 years, they're restructuring their business to move their manufacturing from China to India, right? So there is a lot of tailwinds which are there where people are looking at India, and what scores for us is the fact that we have a large domestic market, we have a large availability of labor and so on. I think our challenge is really to get it right is the land reforms. Land is still a problem. People don't get land. There are good examples of companies which announced big investments but couldn't find the ability to execute. And I think it's good to hear the minister talking about the execution challenges and be focused on that. But we can't take it for granted. But I can tell you from both corporates and investor angle, India is probably having their best in terms of attention and alternates. People are trying to say, give me a good reasons why I can't move into India, rather than saying, give me a good reason why I should move into India. And it's really up to us to make, advantage of that. So I'll stop here, Mr. Rangnath, and I'll hand over back to you, and then we can take some questions and so on.
Thank you, Badri. Thanks. Yeah, we are really short of time, so probably I can take one question from any of you. I had a few questions, but I'm not going to ask. I'll talk to Badri later.
I have a request.
Yeah?
Yeah.
Wonderful presentation. Sure. Thank you. No questions.
Anybody? If not,
time to 11:40.
no, he said.
Okay.
Because we are running. Okay. So what we can do is to thank you, Badri, for what you've said. So there is more hope and less confusion than from the time we started in the morning. So India is, like everybody says, in a unique position. The question is now that will we take advantage of that? And that's not left to a banker or to people like us. It is all of us, including the government, who has to come together. I think for the sake of good order, I will close now because we've taken more time because we also started a little late. Thank you, Badri, and thanks to all of you. If you have any questions during the break, please feel free to ask him. Thanks.